So what if you could build a real estate empire and legally just not pay taxes on your gains? At least not right away, and you could do it over and over again. Well, it's not some kind of fantasy. It's a very real, century-old strategy that has quietly built fortunes. Today, we're pulling back the curtain on the 1031 exchange.
Okay, let's put ourselves in the shoes of an investor for a second. You buy a property, you put in the work for years, it goes way up in value, and you think, you know what, the time is right. Let's sell. And bam! The sale is a huge success. You've made a massive profit, and you're already thinking about your next big move. It's a huge win, right? Well, then you remember the tax man is coming.
Or maybe he isn't. What if you could take that entire profit and legally pay 0 taxes on it? At least for now. It sounds almost too good to be true, but this is a real strategy baked right into the US tax code, and it's called a 1031 exchange. Now, you might be thinking this is some brand new, complicated loophole someone just found, but it's not. This rule has been on the books for over 100 years, and to really get how powerful it is, we've got to understand why it was even created in the first place.
Let's hop in a time machine and go all the way back to 1921. Lawmakers had a pretty big problem. If they taxed every single property sale really heavily, investors would just sit on their assets forever to avoid the tax bill, and that would grind the whole economy to a halt. So, the solution was built on a really simple but powerful idea. If an investor just swaps one property for another and doesn't actually pocket the cash, they haven't really cashed out. They've just continued their investment.
Okay, so we get the why behind it. But what exactly is a 1031 exchange? Let's break down what it means in plain English. Simply put, a 1031 exchange lets you sell an investment property and roll all of the money, the entire sale price, into a new one. Now, the key word here, the most important word, is deferring. You aren't erasing the tax bill forever. You're just kicking that can down the road, which means more of your money stays invested and working for you right now.
Here's a super simple way to think about it. Remember when you were a kid and you traded your old toy truck for your friend's really cool race car? No money actually changed hands, right? It was just a swap. You wouldn't expect your parents to get a tax bill for that trade. Well, the 1031 exchange works on that exact same idea. You're trading up, you're not cashing out.
So the concept makes sense, but seeing the actual numbers, that's when it really clicks. Let's walk through a real-world example to see just how powerful this strategy can be.
So check this out. An investor buys a rental property for $300,000. A few years go by, it does great, and now its value has climbed to $500,000. That's a $200,000 gain. Now, normally they'd sell, pay a big chunk of that gain in taxes, and then reinvest whatever is left. But instead, they use a 1031. The entire $500,000 gets rolled directly into a new, bigger property. And that tax bill on the $200,000? Yeah, that gets postponed.
And that postponed tax bill? We're not talking about small change here. Depending on their tax situation, that $200,000 gain could mean a tax bill of over $40,000. But with a 1031, instead of that $40,000 going to the government, it stays in the deal. It basically acts as a supercharged down payment on the next, even bigger property. And this brings us to the real magic of the 1031. It's not just about dodging taxes one time. It's about what happens when you do this over and over and over again. It's about creating a compounding snowball of wealth. The whole idea is incredibly simple. Every single time an investor sells without paying taxes, more of their capital stays in the game. Just think about that path. You could start with a little duplex, then use a 1031 to trade up to a fourplex. Then a few years later, you trade that up for a small apartment building, and eventually a huge commercial property. All while your growing equity is never ever chipped away at by a tax bill. That's the snowball effect in action. But of course, a tool this powerful can't be a total free-for-all. The government has some very, very strict rules. And if you don't follow them perfectly, to the letter, the whole thing can fall apart. So what's the catch? So, this all leads to a really critical question for any investor. Is a 1031 exchange always the right move? And the answer, pretty clearly, is no. Okay, so there are a few major hurdles. First, the deadlines. They are absolutely brutal. You have just 45 days from the moment you sell your property to officially identify potential replacements, and you only have 180 days in total to close the entire new deal. It's a real pressure cooker. Second, this is not a tool for cashing out. If you need the profits to pay for tuition or buy a boat, a 1031 is off the table. And finally, you have to swap for a like-kind property, which, for the most part, means one investment property for another, not for your personal dream house. So here's the bottom line, the most important takeaway. The 1031 exchange is designed as a vehicle for growth, for continuous reinvestment. It's fundamentally a strategy for building long-term wealth, not for taking your profits off the table and walking away.
For more than 100 years, this one rule has been a quiet cornerstone for building real estate fortunes, letting investors trade up again and again. It really leaves us with a powerful question. Now that you know how it works, how would you use a tool like this to build your own future?